Welcome to the Nifty Noon podcast. Imagine a world where everyday people can bet on OpenAI's valuation before it even goes public.
Right.
And, the U.S. government is locking away a digital asset for 20 years, while Wall Street is just wiring its multi-billion-dollar plumbing directly into decentralized servers.
Yes, which sounds completely bonkers.
Yeah, actually, it sounds like a pitch for a sci-fi novel, but that was literally just this past week.
Just 1 week of news.
Yeah. So we are taking a deep dive today into the past week's most critical developments across, crypto, finance, and tech.
Mm-hmm.
We're trying to pull the signal from the noise directly from the latest dispatches in our newsletter.
Absolutely.
And for you listening, the overarching narrative of this week spanning May 18th to May 22nd, 2026 is this massive, undeniable collision. We're watching traditional finance and decentralized crypto rails just smash right into each other.
A head-on collision, yeah.
Right. The dominant theme here is the breathtaking speed of institutional and nation-state adoption, sitting in stark contrast against the abrupt death of early, clunky retail infrastructure.
And to really grasp the market implications of that collision, we have to look at the mechanics of how one event forces the next.
Right, the chain reaction.
Exactly. This isn't just a list of random headlines. It is a chain reaction. The regulatory shifts create the conditions for capital to move, which in turn
destroys the outdated models.
Yes, it destroys outdated business models, forces retail investors into entirely new synthetic environments, and ultimately pushes this asset class onto the geopolitical stage.
Okay, let's unpack this, starting with the spark that lit the powder keg. Monday, May 18th. The KelpDAO Act officially advanced out of the Senate Banking Committee with, last-minute bipartisan support.
Which was a huge surprise to a lot of people.
Right. And on paper, it's a digital asset regulatory framework. But in my head, I'm picturing a massive plot of extremely valuable yet totally undeveloped land.
Okay, I like where this is going.
Yeah, for years, people have been camping out there, building little wooden shacks off the grid. That's early crypto. Monday's bipartisan vote feels like the city council finally approving the official zoning permits.
Ah, I see.
Like the legal codes required before institutional skyscrapers can legally be built on that land. But I have to push back on the sentiment I'm seeing online.
Okay, what are people saying?
Well, does this mean the Wild West era of crypto is officially dead?
Well, what's fascinating here is that the legislation itself isn't what changes the landscape, It's the fiduciary duty of the capital that follows it.
How do you mean?
Looking at this purely from an impartial, analytical perspective, regardless of the political maneuvering that got the bill out of committee, this bipartisan green light solves a massive mechanical problem for Wall Street.
Right, a legal problem.
Exactly. Trillions of dollars managed by pension funds and major banks simply cannot move into an asset class without legal classification. A compliance officer at a major asset manager doesn't care about the ethos of decentralization.
No, not at all.
They care about whether a token is legally classified as a commodity, a security, or property.
Because if they guess wrong, they get sued into oblivion by their own clients or just, shut down by federal agencies.
Precisely the friction point. So the KelpDAO Act essentially provides a safe harbor. It defines the boundaries.
So Monday wasn't just a political headline.
Not at all. It was the removal of the primary legal bottleneck. Once you remove that bottleneck, the institutional capital that has been waiting on the sidelines is legally permitted to deploy.
And when those institutional guardrails go up, the expensive, clunky bridges that early adopters relied on are suddenly starved of capital and utility.
Exactly.
Which brings us to the fallout we saw the very next day. On Tuesday, North America's largest Bitcoin ATM operator, Bitcoin Depot, filed for Chapter 11 bankruptcy and completely shut down its network.
The entire network.
Yeah. I struggle to buy the mainstream narrative on this one, though.
Why is that?
Well, if the asset class is booming and hitting the front page of the Wall Street Journal, shouldn't physical ATMs see a massive spike in foot traffic from curious everyday people?
You would think so on the surface.
Right. A bankruptcy right now feels like a fundamental failure of retail interest, not just a single company going under.
Well, if we connect this to the bigger picture, the unit economics of a physical Bitcoin ATM explain the collapse perfectly. It actually signals market maturation, not a lack of interest.
Really? How so?
Think about the friction involved. You operate a physical machine. You have to pay rent to the gas station or the convenience store hosting it.
Oh, right, the physical footprint.
Yeah, and you have to pay armored trucks to securely transport the physical cash people insert. You have maintenance, hardware upgrades, and local licensing fees.
So the overhead is astronomical compared to a simple piece of software.
Which means to turn a profit, these operators were charging exorbitant fees. Sometimes 15 to 20% spreads on a single transaction.
Wow, that is wild.
Yeah. 5 years ago, if you were unbanked or just didn't trust linking your bank account to an early crypto exchange, you paid that premium. You walked up to the kiosk, fed it a $20 bill, and absorbed the fee.
Right.
But as digital assets become seamlessly integrated into mainstream banking, which is exactly what Monday's legislation accelerates, that entire business model evaporates.
Because everyday retail users don't need physical kiosks anymore.
Exactly. They're opening highly intuitive mobile wallets or traditional finance apps and buying the asset with an API call for a fraction of a percent in fees.
So the high-fee physical kiosk becomes entirely obsolete overnight.
Yep.
So the ATM dies because acquiring the asset became frictionless, not because the demand vanished.
That's it. It's the Blockbuster video of crypto.
Demolished by streaming.
Exactly.
Man. And with those physical bridges gone, retail capital didn't just exit the space. It moved into highly sophisticated digital arenas that simply couldn't exist a few years ago.
Oh, definitely.
Because by Wednesday, the newsletter was breaking the news about Polymarket partnering with NASDAQ Private Market.
This is where the architecture of finance starts to fundamentally fracture and rebuild itself.
Yeah. They are launching prediction contracts tracking major private tech startups and unicorns, specifically targeting giants like OpenAI.
Right.
Here's where it gets really interesting. I was trying to wrap my head around this, and the closest analogy I can think of is a pari-mutuel betting system at a horse track.
Oh, that's an interesting way to look at it.
Right. Instead of waiting for a venture capital bookie to set the odds are dynamically set by the aggregate money of the crowd. But we aren't betting on horses. We're betting on the multi-billion-dollar valuation of tech behemoths before they ever hold an initial public offering.
The pari-mutuel analogy is strong because it highlights the removal of the gatekeeper.
Right.
Historically, the life cycle of a tech giant is locked behind closed doors. You have seed rounds, Series A, Series B, and so on.
Totally opaque to the public.
Exactly. And if you are a retail investor, you are legally barred from participating in those rounds unless you are an accredited investor with millions of dollars.
Right. You just can't get in.
The venture capitalists take all the early risk, but they also capture the exponential 100x growth.
And then, when the company finally IPOs, retail investors are allowed to buy the stock. But by then, the massive growth has already happened.
Yeah, you're basically just buying the exit liquidity for the early VC investors.
Exactly. The everyday investor is left fighting over single-digit percentage gains in the public market.
Which is exactly what Polymarket and NASDAQ Private Market are changing. They're creating a synthetic bypass.
A synthetic bypass.
Yeah, by launching decentralized prediction contracts based on the specific revenue milestones or valuation targets of private unicorns, they are synthesizing private equity exposure.
Wait, walk me through the actual mechanics of that. If I buy a contract, I don't actually own a share of OpenAI, right?
Correct. You own a digital contract that resolves to a specific payout based on an outcome. Let's say the contract is OpenAI achieves a $150 billion valuation by Q3.
Got it.
If the market believes there is a 60% chance of that happening, the contract trades at 60 cents. If it happens, the contract pays out $1. If it doesn't, it goes to zero.
Makes sense.
But here is the critical part. As new information comes out, like a new product launch or a leak about revenue, that contract price fluctuates dynamically in real time. Traders can buy and sell these contracts continuously.
So you are capturing the financial upside of the company's growth trajectory without ever touching a traditional share of stock.
Or needing a venture capital license.
That is wild. That is a $5 trillion private market suddenly crowdsourced to the public. It completely rewires who gets to participate in high-tier finance.
It democratizes access to probability. And crucially, it requires highly robust, highly liquid decentralized infrastructure to function at scale without failing.
Which feeds perfectly into what happened on Thursday.
It does.
Because that synthetic market creation requires deep liquidity. And on Thursday, we saw an absolute flood of direct institutional capital pouring into decentralized exchanges, specifically Hyperliquid.
An absolute flood.
Yeah. The newsletter highlighted a massive rotation. We saw ETF inflows, a highly lucrative USDC yield-sharing deal, and direct exposure from players like Goldman Sachs.
Which is huge.
It is, but I have a serious bone to pick with this development.
Oh, let's hear it.
We are talking about traditional Wall Street behemoths piling their money into a decentralized exchange. Isn't this just TradFi trying to put up a toll booth on a public road?
A lot of people feel that way.
Like, it feels like Wall Street is just co-opting and swallowing decentralized finance to maintain their monopoly.
This raises an important question, and it is the central ideological debate happening in the space right now. Are the institutions co-opting decentralization, or is decentralization quietly assimilating the institutions?
Okay, what's your take?
To answer it, you have to look at the plumbing. Wall Street institutions are deeply pragmatic, ruthless entities.
Very true.
They do not care about the cyberpunk ethos of crypto. They care about settlement times, counterparty risk, and capital efficiency.
Right. If a new system saves them a fraction of a penny on 1 billion transactions, they will adopt it.
Exactly. In traditional legacy finance, if a hedge fund trades an asset, that trade often takes 2 days to officially settle, what they call T+2 settlement.
Yeah, right. It goes through the clearinghouses.
Clearinghouses, brokers, and custodians. Capital gets locked up during that window, which creates risk. But a decentralized exchange like Hyperliquid operates on an open ledger.
So it's much faster.
Trades are settled nearly instantly, transparently, mathematically, and 24/7. There is no middleman clearinghouse to take a cut or delay the process.
So Wall Street isn't trying to fight the decentralized order book. They are realizing it's just a superior database architecture.
Precisely.
But what about the USDC yield sharing deal? How does that fit in?
Well, USDC is a digital stablecoin pegged to the US dollar. For a decentralized exchange to function, it needs deep pools of liquidity.
Essentially huge piles of assets sitting in smart contracts so traders can swap between them instantly.
Right. If Goldman Sachs or a major ETF provider parks billions of dollars of USDC into those liquidity pools, they provide the oil that makes the decentralized engine run.
And what do they get for it?
In exchange, the protocol pays them a yield cut of the trading fees.
Ah, so they aren't hostile taking over the exchange. They're acting as the utility providers.
Yes.
They supply the digital dollars, they collect the yield, and the decentralized exchange gets the massive liquidity it needs to facilitate those synthetic private equity bets we talked about on Wednesday.
It is entirely symbiotic.
That's a huge shift.
Wall Street gets higher yields and instant settlement. Decentralized finance gets the trillion-dollar depth of legacy capital.
Wow.
So Monday provided the legal clarity, Wednesday created the synthetic demand, Thursday connected the multi-billion-dollar plumbing.
The speed at which this is escalating is just staggering to witness.
It really is.
And that escalation scaled up yet again to close out the week, because if Thursday was about Wall Street adopting the plumbing, Friday was about nation-states adopting the asset class at a geopolitical level.
A macro endgame.
Yeah. We saw bipartisan lawmakers introduce the ARMA Act. The explicit goal of the legislation is to formally enshrine a strategic U.S. Bitcoin reserve into federal law. And the detail that caught everyone's attention, it legally mandates locking that reserve up for at least 20 years.
A sovereign 20-year mandated lockup. When you strip away the politics and look purely at the macroeconomic game theory, the implications of that specific time frame are monumental.
I just have to pause and marvel at the pure narrative shift here. I mean, just over a decade ago, this was a decentralized internet coin that early cypherpunks were using to buy pizzas on obscure cryptography message boards.
Right, the early days.
And now there is federal legislation aiming to treat it like a Fort Knox gold reserve. But walk me through the mechanics of that 20-year lockup. Why does that time frame specifically trigger such a massive market reaction?
It comes down to the fundamental math of a hard-capped asset. There will only ever be 21 million Bitcoin in existence.
Right, and many of those are already lost forever.
Exactly. So the available float, like the amount actually circulating on exchanges available for purchase, is surprisingly small.
Okay.
If the United States government legally commits to accumulating a massive strategic reserve of this globally decentralized asset and explicitly writes into law that those specific assets cannot be sold, lent out, or traded for 2 decades.
They are effectively removing a massive percentage of the global supply from the board entirely.
It creates an artificial, state-sponsored supply shock.
Wow.
And international finance is a zero-sum game of strategy. When the U.S. signals this posture, every other nation-state sovereign wealth fund and allied or adversarial central bank is forced to evaluate their own balance sheets.
Because if they suspect the U.S. is going to absorb the remaining available supply, they face a prisoner's dilemma. Meaning, even if another country doesn't inherently love the asset, They can't afford to be the only one left holding zero when the music stops.
If the U.S. controls a significant portion of a neutral, highly liquid global reserve asset, any country lacking exposure is at a strategic macroeconomic disadvantage.
So it forces their hand.
It triggers an arms race. Foreign central banks begin bidding on a shrinking pool of supply. So, tracing the week's continuity,
Yeah, let's look at the timeline.
Monday's Clarity Act set the domestic bureaucratic rules. Thursday's Wall Street integration into decentralized exchanges proved the financial rails could handle the volume. And Friday's ARMA Act represents the ultimate geopolitical validation.
You pull back and look at that timeline, and it really is just one continuous domino fall.
It is.
Regulatory clearance unleashes the capital. The old retail bridges die because they can't compete with the new efficiency. That efficiency creates entirely new synthetic markets.
Right.
Wall Street hooks up the liquidity plumbing to feed those markets, and then the nation-states start hoarding the underlying asset.
And for you listening, this is where the skill of filtering information becomes critical. In a week with this much velocity, you have to distill the signal from the noise.
So what would you classify as the noise this week?
The bankruptcy of the Bitcoin Depot ATM network.
Really? That's the noise?
Yeah, a casual observer or a sensationalist headline writer sees that and declares, retail crypto is dead, the bubble is bursting.
Right.
But that is pure distraction. The death of the ATM network was simply the shedding of a rudimentary skin. The real signal, the profound structural shift, is the undeniable institutionalization happening across both the private sector with legacy banks and the public sector with Federal Reserves.
The foundational technology is maturing, and the institutions are realizing they have to adapt to the rails rather than forcing the technology to conform to their outdated systems.
Exactly.
We are watching the real-time rewiring of global finance. It is going to be incredibly fascinating for you listening to watch how traditional banking infrastructure attempts to manage this newly unlocked decentralized liquidity over the coming months.
It's going to be a wild ride.
Thank you so much for joining us on this deep dive. Don't forget to subscribe to Nifty Noon on X and Substack so you can catch these critical updates daily directly from our newsletter.
And I want to leave you with a final thought to mull over as you go about your day.
Oh, yeah. Go for it.
We just mapped out a reality where the U.S. government is preparing to legally lock up decentralized assets for 20-year stretches,
Right.
while Wall Street giants are routing their capital directly through decentralized order books.
Yeah.
So if the macro level and the institutional level are abandoning legacy plumbing, what exactly will be the role of your traditional local branch bank a decade from now?